Hi everyone, welcome back to our discussion for Accounting 163, working our way through the chapters now, looking at Chapter 8. So you got a chance to see Chapter 7, hopefully you got through those homework questions, quiz questions, etc., looking at how the auditor looks at the internal control in order to determine the timing, extent, and nature of our substantive procedures. So what we're going to do in this chapter now is look at how the auditor will use sampling to help to test the operating effectiveness of the controls. Remember, we looked at the design, we've seen that they've been implemented, but we also have to test operating effectiveness. And typically, an auditor is not going to be able to look at an entire population of transactions to see if a control was applied consistently throughout the year. So we would pull a sample of transactions, and I think we referred to inventory control sheets and that sort of thing in some of our examples from Chapter 7. We'd pull a sample of those instead of looking at all of the, let's say the company had 10,000 documents that were signed off on over the course of a year or something. We're not going to look at all 10,000 of those. We'd be there forever, right? So we'll pull a sample of, say, I'm just making the numbers up, 110 items. And we'll look at those 110 items, and that will give us evidence to help us determine if the control had operating effectiveness. So we'll use sampling, as you can see, in the context of our test of controls, and that's the main focus in Chapter 8. But we will also be able to look at the use of audit sampling in the context of our substantive testing as well. Okay, so this focus here, we're going to talk generally about sampling, but we're also going to talk about it in the context of how it'll help us with our internal controls. Okay, we'll get into the substantive testing, as I said, next chapter, Chapter 9. All right, so let's just go ahead and take a look, and they tell us that generally accepted auditing standards, our GAS standards, and PCAOB allow us to use audit sampling. Okay, now I circle the word permit though, because I think that sometimes you'll see homework questions, that sort of thing, that'll make it sound as though the auditor is required to use sampling in the course of an audit, and we are not required. We are allowed to, and it's going to have certain advantages, but we could also use non-sampling techniques, and we don't have to use statistical sampling. We could use both statistical and non-statistical sampling as well, and we're permitted to use both by standards. We are not required to use neither statistical nor non-statistical sampling. Okay, now they tell us here that there are a few circumstances where an auditor might do 100% testing, and they're saying that these days, because we are able to use software to test an entire universe of transactions for critical elements, say looking for indications of fraud, they have software that are able to sample every single transaction for those indications, or evaluate every single transaction for those indicators of fraud. And that would be something where we would be using the software to do 100% testing. But regardless, most audit, you are not going to be able to do a complete 100% audit of every single transaction. I mean, think of trying to audit a company like McDonald's, let's say, with billions of transactions. There is no way that you're going to be able to do 100% testing in an entity like that. And so in most cases, we will have to use some amount of sampling for some of the accounts, assertions, etc. Remember, we are always auditing the assertions. And again, we could use statistical or non-statistical sampling. And most of our focus here, by the way, is going to be on statistical sampling. In this chapter, as it relates to internal control, will be the primary focus. And then as it relates to substantive testing, will come up in Chapter 9. Okay, so let's just go ahead and continue on now, taking a look at the different types of key definitions that we're going to be focusing on here. Okay, so some key definitions that you can see on the screen here include this idea of audit sampling. Okay, what is audit sampling? What does sampling in general mean? Sampling means that we will look at less than 100% of the items in a population to make our final conclusion about that population. Okay, now we're going to talk about it in the context of our audit sample, but let's just think about it generally. Okay, you have a barrel of apples up here, and I have 100 apples in the barrel. And I tell you, there's a chance that some of these could be poisoned. So I say, would you like to try an apple? You say, no way, they could be poisoned. So I said, no worry, we'll take a sample. So we go ahead, we take a sample of apples, okay, this is baseball, but we put them in the machine. Machine comes back, we test 10 out of the 100, indicates that there's no poison. So what do we say? Okay, should we just reach in, put the apples back in the barrel, mix it up and reach in and start eating apples? No, because there's a chance that that sample that we just took is not representative of the population. So you can instinctively feel the concept of sampling risk, right? Now, as you relate that to an audit, I don't know, we want to see if a supervisor appropriately signed time cards. So we take 100 time cards out of a universe of 10,000. We don't want to look at all 10,000 time cards. We pull a sample, 100 time cards, supervisor signed them every single time. Now we look at that and say, okay, does that mean that the population has no deviation? No, it does not. We're going to make a projection based on the sample, but there's a chance that out of the 10,000, there could be an unacceptably high level of time cards that didn't get signed, okay? Confidence level is going to tell us just how reliable we think our conclusion is, okay? We will literally be able to say we are 95% confidence, 95%, 99% confident. Now, when we're saying that, at the same time, we're also saying that we're 5% wrong, we're 10% wrong, 5% wrong, 1% wrong. It's the complement of our confidence level is how big we think the chance is that we've made a mistake, okay? So that's called our confidence level. And then we'll have the tolerable and the expected rate. Tolerable rate is the most amount of deviation from a control or misstatement that we're willing to accept in a population without determining the control does not have operating effectiveness for our control testing, or that the account balance is materially misstated for our substantive testing. It's the amount we'll tolerate before we'll make the conclusion, or the expected error is based on past transactions, or past experience, I should say, with that client. Okay, so we come over and we take a look at each of these. Audit sampling, as we've said, is when you look at what, less than 100% of the items in a population. And auditors are going to do that all the time. You audit McDonald's, you've seen the signs, the billions and billions. You're not going to audit every single transaction. You're going to want to pull a sample of those transactions to see that the control has operating effectiveness, that the account balance is not materially misstated. Okay, so our expectation is that it will provide a reasonable measure of the population, not absolute, not perfect, because again, remember we have that audit sampling, right? So it's absolute, it's reasonable, not absolute. Come over, types of items that you would use sampling for, inspection of assets, right? You're going to go, you're not going to look at every single piece of equipment that they have in every single building that they have all over the world. You'd probably pull a sample of assets to look at those, okay? Reperformance, and I circled that one. That's for our control testing. You sit in management seat, you look over a transaction, and you reperform the control. And in doing that, you can see how that particular transaction was processed and how the internal control is applied, and see if you come to the same conclusion that management does about that. Reperformance, very top of the pyramid type of control test, but you can't do that for every single transaction, so you use sampling. Confirmation of our accounts receivable, let's say. What happens? Our client has 1 million customers. You can't send a confirmation out to all 1 million customers most likely and say, okay, do you agree with this account balance on the confirmation? So what do? We would maybe pull a sample of, say, 100. I'm just making these numbers up, but we pull a sample of 100 and we send those out to see if those were the client properly agreed with those balances, and we make our conclusions based on the sample. Okay, so for large volume of transactions, large number of items, sampling typically comes into play for us. Okay, now you take a look, and when we talk about intangible assets, okay, we're going to physically inspect that asset, look for obsolescence, those sort of things. Inspection of documents, maybe looking for the client's signature, right? We're going to use sampling for that. Reperformance I've talked about, confirmation I've talked about, so you can see a little more detail I probably gave you on the first slide about these different areas where sampling would be used. Okay, good. Now let's look at this next one, and what they're trying to introduce here, even though they don't call it out on this slide, is this idea of stratification. Okay, so how does stratification look? Well, I wrote in here and I gave an example. We have an accounts receivable. Let's say the total account receivable is 100,000, and let's say we have 100 accounts receivable that my client has, and I don't want to look at every single one of those. So what do? I would look at how that numbers in that account receivable balance is arrayed. And if I see some large ones there at the top that you can see, these first 5, 10,000, 10,000, 3 5,000s, that total up to what? A total of 15 and 10 is 25, 35,000, John. This is 35,000. Okay, check my math on that. Always check your math, even if they won't let you erase it after the fact. So I don't know why it's not letting me erase. Probably just to embarrass me all the more. That's what? That's 35,000 divided by the 100,000 items. That means that I looked at what? 35% of the dollar balance here by just looking at these top 5, right? Meanwhile, there was a total of 100 accounts receivable in that population, and if I've looked at 5, what's happened? I've looked at 5 of the remaining 95 are going to total 75,000, but by looking at 5% of the population, I've gotten a 35% dollar coverage. Okay, that is an auditor using their resources efficiently by using this concept of stratification, and then we'd probably use sampling on those remaining 95 and send out confirmation on those. You don't want to ignore those small ones. You want to do some audit work with those, but you're getting a nice dollar coverage there, doing less audit work, looking at less items in the population, getting a higher dollar coverage. That's called stratification. Okay, now you come over and you take a look at our controls. And remember, we talked about our IT controls, and with our IT controls, you may want to use sampling to test those. Most likely, you're not going to use sampling for things like general controls. General controls include what? Include password protection. You're going to do some penetration testing over that, but you're going to do a sample. You're going to see if you can hack into the client's entire system, right? When you're at the system level, are they using proper disaster recovery? Well, that's not something that lends itself to sampling, okay? Now, when you get into application controls, which might have dollar limits over different types of transactions, etc., then again, you may want to sample some of those without having to go through and test every single application control. Remember, we said that we first look at the general controls, right? We want to make sure that those are having the appropriate effectiveness. Otherwise, the application controls become almost irrelevant, okay? Unless first the general controls, then the application controls. And we could use sampling over the application controls. Okay, good. Now we come over and we take a look at some of the advantages and disadvantages of sampling. Some of the advantages: we're going to be more efficient if we use sampling. It'll allow us to measure the sufficiency of our audit evidence. We'll be able to say things like, we are 95% certain that the true account balance does not exceed a certain dollar amount. As you can imagine, that lends an incredible amount of confidence to our audit opinion and to our credibility, and allows us to communicate with others the degree of confidence that we have in our conclusions, and we can state that mathematically. So that's a huge advantage. We can quantify the sample, again, saying what the chances are that it's within a certain dollar range. Disadvantage of sampling: got to train our staff, got to teach them how to use some of these generalized audit software packages that carry with them sampling packages, etc. Now, again, once we get good at that, that's sort of a return on investment up front. In the early stages, it may not be worthwhile, but if you extend that over the course of years, where we start to develop more and more understanding and expertise, and a staff with that understanding and expertise, that could actually have a short term, maybe a disadvantage. It could be an advantage in the long run. Okay, good. Now, when we take our concept of sampling risk, we're going to see it in the context of the overall picture of audit risk. So remember, we said audit risk equals what? Our inherent risk times our control risk, which is our risk of material misstatement. We make an assessment of our risk material misstatement. We respond through our substantive testing, timing, extent, nature. So we are going to control it through our detection risk, right? Now, you come over and we talk about uncertainties affecting audit risk, those due to sampling, those that are due to non-sampling issues. Now, when we look at the sampling, I'm pointing up here. It's kind of a mess for you to see exactly what I'm pointing to, and it's too late for me to erase it for some odd reason. Okay, so when we look at these, we take a look and we put them in the context of our uncertainties due to sampling. What I was trying to put here, affecting our control risk and affecting our detection risk. Why? Because we'll use sampling for our control testing. We'll use sampling for our substantive testing. So the control testing is affecting our CR. The substantive testing is affecting our DR. We're using sampling for those. So that's how sampling risk is feeding into our overall audit risk. IR, not as much, probably not going to use sampling as much for that. It's possible, but understanding things like how the economy is affecting our audit risk, how changes in accounting principles, changes in the entity staff and whatnot, the complexity of a transaction are affecting our audit risk are probably not things that lend themselves as much to sampling, okay? More towards the DR and the CR. And we're going to study and break the CR and the DR up to even more understand how that would affect our auditing risk here, our sampling risk, and that's our auditing risk in a couple seconds. But before we do that, uncertainties due to factors other than sampling, and I'm kind of pointing back up to detection risk, because if you read these, they're basically saying, auditor, you're human. Okay, you could select the incorrect procedure. You could have an error right there in front of you, and because you had a long day, you didn't detect that. You had a, fight with your significant other, and your mind is on something else. Okay, all of these things, the human element, and I'm thinking they're probably affecting the detection risk, but it could be affecting control risk as well. But the key takeaway is they are not due to sampling. Okay, so you come over to the next page and we start to take a look at our sampling risk, and now we're going to break it into the components for our substantive testing, and on the next slide our control testing. Okay, when we talk about our substantive testing, we can break it into our risk of incorrect rejection, which is considered a type 1 risk, our risk of incorrect acceptance, which is considered a type 2 risk. Okay, so you come over to the next page and same information over here, although we didn't label it as type 1, type 2 for our risk of incorrect acceptance and our risk of incorrect rejection. But let's just look at it here because I think it gives us more of a feel for what we're looking for here. So we have sampling risk in our substantive testing. We have incorrect acceptance, incorrect rejection. Now I underscored the word incorrect here because this is a mistake. We are incorrect, right? You get something wrong on an exam, you made a mistake, they call that incorrect. So this is a mistake. This is incorrect acceptance, incorrect rejection that the auditor makes based on the sample. Okay, so incorrect acceptance, what happens here? The auditor concludes that the financial statements are not materially misstated when in fact, if I, based on the sample, pull the sample, 100 confirmations, everything came back okay. So I conclude that the financial statements are not materially misstated based on the sample, when in fact, if I had looked at more transactions or all the transactions, whatever, I would have determined that there was a material misstatement. So I incorrectly accepted these financial statements. That's bad. That's audit failure. That is not an effective audit. Okay. Risk of incorrect rejection is what? I pull my sample, I find errors. I say, you know what? Based on these errors, I determined that this population is not correctly stated, is materially misstated. And so what happens? I reject that account balance. Now, what do? If I have any sense about me as an auditor, I won't run into management at that point and say, hey, you have a material misstatement. Telling management that their financial statements are materially misstated is like telling someone their kid is ugly, right? You don't want to do that. So what happens? You sit there and you I want to make sure this kid is ugly. I want to make sure that, there's actually a problem with these financial statements. So you're going to test some more because you don't want to run in and say the wrong thing, upset everybody, right? And when you pull more items to look at, you say, wait a minute, there is not a material misstatement here, right? And so what happens? You're going to get to the right conclusion either by yourself, or if you're calling management in and you tell somebody their kid is ugly, they're going to prove to you that their kid is the most beautiful ever. But you'll still come to the right conclusion, just not in a very efficient manner, because you're going to have to do additional work, right? Okay, so incorrect acceptance, incorrect rejections, mistakes made by the auditor based on the sample, right? Now, that's our sampling risk as it relates to DR, right? Now, we also said that our sampling risk would relate to our CR, to our control risk. And so let's take a look here. And we have the risk of assessing control risk too low, risk of assessing control risk too high. Both of these are mistakes made by the auditor based on the sample, right? Too high, Stephen Curry shooting a basket. He shoots too high, goes over the backboard, it's too high. Shoots too low, goes under the rim, he shot too low, but he didn't make the shot, right? So what happens? We made a mistake based on the sample. Okay, now based on the sample, we assess control risk too low. What does that mean? Well, we want to test operating effectiveness. The client tells us that the supervisor signs a time card. So we sit there and say, okay, sounds like pretty good control. The supervisor should know if the employee worked the number of hours that they put down on the time card. We like the design based on what I just said. We see that it has been implemented because we came early and saw the supervisor interacting with the staff and directing them and watching their day-to-day work, so they have justification for signing the card. So, okay, implemented. We test operating effectiveness. We pull 100 time cards out of the 10,000, say, the client uses, and we look at those 100. Every single one of them are signed. We determine the control has operating effectiveness, when in fact, if we had looked at all 10,000 time cards, we would have found that the supervisor didn't sign 1,000, 2,000 of them. The supervisor was derelict in their duties in signing that. But we determined that the control had operating effectiveness based on the sample. We have assessed control risk too low. Now, what's going to happen? Because we assess control risk too low, what are we going to do? Okay. Nature, we might use internal evidence when we should be using external. Extent, we should have taken larger sample sizes for our substantive testing, right? Same thing for the using internal evidence instead of external. We use internal evidence for our substantive. We should have used external. When we do our substantive test, we use smaller sample size and we should have used larger. We're doing too much interim testing. We should have done more testing at year end because our control risk was higher than we thought it was. So there's a chance now. We haven't lowered our detection risk enough, so there's a chance that we are going to miss a material misstatement. So our audit is not going to be effective if we assess our control risk too low. Okay. Conversely, you assess control risk too high. What happens? Pull the time cards, look at 100 of them, find 5 of them that not signed. We say, wow, that's way too many that weren't signed out of 100. We're going to determine this control does not have operating effectiveness. Meanwhile, if we looked at all 10,000, it turns out that's only 5 times a person didn't sign it. We were unlucky. Okay, we've got all the time that they didn't sign it within one sample. And so what happens? Based on the sample, we assess control risk too high. So we're not relying on controls that we could have. So what are we going to do? Well, we're going to nature, use external evidence, extent, take smaller sample sizes, timing, do year-end testing, when we could have used internal evidence for our substantive testing, taken smaller sample size for that testing, and relied on some interim testing. So what happens? We are probably going to come to the right conclusion. In fact, we've probably now over-audited, haven't we? But so we'll come to the right answer, but in an inefficient manner. Okay. So if you go over to the next slide, you take a look. When we have efficiency issues, it's because we've assessed our control risk too high, or we have done what? We have suffered the risk of incorrect rejection. In those instances, this assumption is you're probably going to come to the right conclusion, but in a non-efficient manner, okay? Effectiveness, if you assess control risk too low and therefore don't do the right amount of substantive testing, or you incorrectly accept the financial statements, which is essentially audit failure. You give an unmodified opinion when you should have modified somehow through a qualification adverse or whatever. That is the sheer definition of an ineffective audit. Okay, good. So you come over and we summarize some of that on these little tables here, which are pretty good. Sample indicates the population is okay, and it is okay. Ding, that's a correct decision. Sample indicates the population is okay. When it's not okay for our substantive testing, that's the risk of incorrect acceptance. Our audit will not be effective. You go down to testing controls, indicates that the population is okay and is okay. That's great. Sample indicates that the population is okay. When it's not okay, that's an incorrect decision. We assess the control risk too low. We assess control risk too low. What's going to happen? Probably not going to do enough substantive work, not going to lower our detection risk sufficiently. So as a result, we're probably going to miss a misstatement. Our audit has the increasing potential here of not being effective. Okay, and you can see some of the other options here, but I think this is a nice table that you probably want to spend some time with looking at and seeing how how this lays out, and you'll get some questions definitely in your homework and stuff on that. Okay, now 3 important factors in determining sample size that we're going to talk about: confidence level, tolerable error, or expected error. Okay, confidence level is how confident we are in our result. We are going to say we are 95% confident. Now, if we tell you we're 95% confident, guess what? That means there's a 5% chance. We're telling you there's a 5% chance we messed up. We made the incorrect decision based on the sample. It happens. Samples are not always representative of their population, right? If we want to get that down lower, we can go to 99% confidence, which means there's only a 1%. But we'll see how we'll manipulate essentially our sample size to help us with that. But you need to understand that sampling, the confidence level is the inverse of our risk, okay, or the complement, okay. And you come over, and when we talk about tolerable and expected error, tolerable error is the most error the auditor will allow in a sample and not determine that the account balance is materially misstated, okay. What do we mean by that? Tolerable. Well, what happens? Or determine the control does not have operating effectiveness. Either of those goes with the word tolerable. But let's talk about tolerable deviation rate. Now remember, we said that the lower you're trying to get your control risk, the more better evidence you need to allow you to determine that you have supported that lower assessed level control risk. So let's say we set our control risk at low. We're going to look at what? A lot of items to see that the control was properly applied to those transactions. We'll be doing what? Some reperformance level type control tests on that. Remember that I'm doing this because of that little, I'm not praying, I'm doing that because of the pyramid that we talked about. And then we're going to do what? We're going to probably have a low expected deviation rate, a good tolerable, not expected, but tolerable deviation rate. We're going to put that at low because this is an important control that is allowing us to assess our control risk at low. So we're going to sit there and we're going to what? We're going to want to set that tolerable deviation rate at, say, 1-2%. We expect that most of the time that control better be working. So that's how we'll set a tolerable rate. Expected rate is based on past experience with our client, and expected rate versus tolerable rate is really not where I want us to focus our evaluation of tolerable rate. We're going to see later when we assess the results. We'll take that tolerable rate and we'll compare it to the actual deviation rate, or something called the upper deviation rate to be more precise, and that'll allow us to really see if we have met our objective of determining the control has operating effectiveness through our sampling. So we'll worry about that concept more when we get to the evaluation stage. So right now, just understand tolerable is the maximum rate of deviation the auditor is willing to accept. Expected is what we expect based on past experience with that client, etc. Okay, good. Now, a couple things here. The literature that they use to test you, they're training you as an auditor, is always to get you to think that there's something in the standards, a provision in the standards that allows you not to use judgment. And just purge that from your mind. There is no concept, no procedure, nothing that allows the auditor to not apply judgment. You always apply judgment. So sometimes I say, if an auditor uses audit sampling, you don't have to apply judgment. Yes, you do. You always have to apply judgment, whether you're using non-statistical or statistical sampling. Again, remember, the standards permit us to use both. They don't require either or prohibit either or the other, but they permit us to use both. But nothing replaces judgment. Okay, so let's take a look now that we've got some key definitions under our belt. And we're going to actually start to apply some of these concepts in a second, but let's just test real quickly if we understand some of the key concepts here. So an advantage of statistical sampling over non-statistical sampling is that what? It allows us to quantify the amount of risk that we're taking or the sufficiency of the audit evidence. We're able to say we are 95% certain that the true account balance does not exceed some dollar amount. So we're able to communicate with others and literally quantify how much risk we're taking, how certain we are. That's the real beauty of using statistical sampling. You can't do that with non-statistical sampling. Okay, take a look at the next one. Which of the following best illustrates the concept of sampling risk? Sampling risk is the risk that you'll eat a poison apple based on the sample. The sample will indicate the population is okay when in fact it is not okay. That is sampling risk, and you don't have to live with that when it comes to eating apples, but you do have to live with that when it comes to making decisions about the fair presentation of financial statements. Okay, take a look at the next one. Sample to test internal controls are intended to provide a basis for an auditor to conclude whether, well, when we're testing internal controls, remember, I keep beating you with this, I know, but you're going to be walking out of this class knowing these terms, that you sit there and you have to obtain an understanding sufficient to evaluate the design of the control, determine the control has been implemented, right? That will allow you to make an assessment of the risk of material misstatement. You assess that risk of material misstatement at the maximum. Forget the control testing, go straight to substantive testing. But if you have assessed that risk of material misstatement at less than the maximum, you must test what? Operating effectiveness of the internal controls, okay? And we're going to be using sampling to help us to test that operating effectiveness. And we're literally going to be able to say how confident we are in our conclusions regarding that operating effectiveness. We can quantify that if we use statistical sampling, and that's what we're going to be talking about. And you'll see how we'll apply the numbers here in a little while, okay? Take a look at the next one. The likelihood of assessing control risk too high is the risk that the sample selected to test controls does not support the planned assessed level of control risk when the true operating effectiveness of the internal controls justifies such an assessment, okay? So what happens? The operating effectiveness, we assess control was too high. The operating effectiveness could have been justified, but it was not based on the sample. So we assess control risk too high, okay? Okay, good. Come over. The risk of incorrect acceptance and the risk of over-reliance relates to what? The effectiveness of the audit. This is assessing control risk, what? Too low, okay? The over-reliance and incorrect acceptance is, of course, as we said, you could have answered the question just based on that, is the situation where we have had audit failure. We've incorrectly accepted these financial statements. Okay, coming over to the next one, we're performing a substantive test of details during the auditor. The auditor determined that the sample results supported the conclusion that the recorded account balance was materially misstated, and in fact was not materially misstated. This is incorrect. Rejection. Okay, coming over, underlying feature of random-based sampling is that what? Every item has to have an equal chance of being selected. That's why you'll use a random number generator or something when you're going to pull your sample. You can't just say, okay, let me pull number 1 or every 5th one. That's not random selection. So you're going to have to do what? You're going to have to use a random number generator. So you start at the 5th one, and then if you want to, or the 3rd one, whatever, and then if you want to, you can pick every 5th after that or something, but you have to have a random start so that every item had an equal chance of being selected. Okay, all right, good. So what we're going to do is take a quick break right here, and then we're going to come back and start to dig in and understand a little bit about some of these different auditing techniques, although frankly we'll focus mostly on attribute sampling, which is for our control testing. Okay, but before we do all that, I'm going to go ahead and pause us real quick, and we will take a quick break, and then we'll come back and finish this up, okay? Okay, so let's go ahead and continue on now, and let's take a look at the different types of sampling techniques that we're going to be talking about. And primarily in this chapter, we're going to be focusing on attribute sampling, which is used for internal control testing, which is the focus of this chapter. But there's also a couple of other sampling plans that we will talk about more in chapter 9, which are going to be monetary unit sampling and classic variables sampling. And again, that's used mostly for our substantive testing, which is our focus of chapter 9. Now, when we look at attribute sampling, it is used to look for a specific characteristic. And this is why we would use it for our internal control testing, because we're looking at, say, a set of time cards and looking for the characteristic, the supervisor signature, or we're looking at sales orders and expecting that there'll be the appropriate credit approval. Now, again, when we look for these internal controls, and really when we're using sampling, we're looking at internal controls over specific transactions. We're looking for the control that would help prevent or detect the misstatement in an assertion. So if we were looking for, again, the example, credit approval over our sales orders, as we've mentioned previously, that would help us with the valuation assertion, because if we have the appropriate credit approval, then if our client sells goods on credit, we know that they've checked the credit approval first, so there's a better chance that they'll collect on the receivable. If they're going to collect on the receivable, they probably don't have to put as much into the allowance for doubtful accounts because they've done the proper credit check. And so this idea of credit approval helps with the valuation assertion, and we don't have to use as much of our audit resources looking at the allowance account. Maybe we do a quick analytic over that, but we're able to do that. We're able to increase our detection of risk in an approach like that because we think we have a control that will prevent or detect the misstatement in the assertion. And we're using sampling to help see if transactions have the attribute here for our internal control testing for the credit approval, or in this example, looking for dual signatures. Whatever characteristic it is that we're looking for, that's attribute sampling. That's what we use for our internal control testing. Now, you take a look, and we would use monetary unit sampling, which we'll talk about more later. That's used more for substantive testing, even though it uses an attribute sampling approach. We would use dollar unit sampling or monetary unit sampling. Those terms are synonymous for our substantive testing. We'll get more into that in later chapters. Same thing with classical variables. Okay, anytime we're using something to determine the correct dollar value, that's our substantive testing, because we're really focusing then on is the amount recorded properly in the financial statement. So that's the case for monetary unit, dollar value. You see those? I got transfixed on those. I guess those are people holding up that dollar bill, and forgot to mention dollar amounts here. And same thing with classic variables. Okay, so let's just go ahead and take a look. And we say in this question, for which of the following audit tests would an auditor most likely use attribute sampling? And you see some things here, the amount, right? The valuation of fixed assets. A confirmation of accounts receivable is looking at what the existence of the receivable. But when we look at the time cards and looking for supervisors, now we're looking for that particular attribute, the signature. That's obviously an internal control test. We've used that in some of our examples already in our discussion here. Okay, now when we look at the steps, we're going to plan our internal control testing using attribute sampling. We'll perform, evaluate the results, and of course, always we need to document the results of really any audit procedure, and this would be no exception to that. So let's go ahead and let's take a look at these factors affecting sample size. That's really the takeaway of this slide, okay? And the factors, the key ones, are the risk of assessing control risk too low, okay? This is the risk that we will give an incorrect answer, right? The risk that we will assess our control risk too low. If we do, there's a potential that our audit is not going to be effective, right? And so we want to avoid this by keeping the risk that we will make this mistake low. So we might want that risk of assessing control risk too low to be, say, 5%. Now, if it's 5%, that means we're at the, what is it? 95% confidence level, right? Okay, so we want this to be a low occurrence. We don't want this to happen much, okay? So we say that there is an inverse relationship between sample size and the risk of assessing control risk too low. So if we want to lower the risk, larger sample size, if we can accept more risk, we can have a smaller sample size, inverse relationship. Now let's think through this for a second. Go back to that barrel of poison apples that we were talking about earlier, okay? And let's say I have this barrel, what did we say, 100 apples, and we tested 10. 10 came back, the little machine we had to test the apples came back, no poison. Okay, good, so there's no poison in that 10, but you still didn't want to eat any, right? So I say, okay, look, I'll test 20. I come back, I test 20, no poison, less chance that there's any poison apples in there. Now we've tested 20. I say, would you like to eat one? You say, no. Okay, and I keep going, testing more and more apples. Now in that case, you'd probably say, if you're like me anyway, you'd say, you know what? I'm not going to eat any of those apples. You're going to have to test them all before I'm willing to eat one of those apples, right? Because with my luck, I get the one in there that wasn't poison, that was poison. That's the one. We test 99. I say, okay. And I eat the one, and I get that weird sample that simply just was not representative of the population, though it tested 99, right? Well, auditors, of course, can't afford to say, hey, I'm just going to test 100%. Well, you could, but in most cases, if we're using sampling, it's because the population is too big for us to do 100% testing. And you can't live with, well, I'm just not going to, I'm going to insist on sitting here and testing 10,000 time cards. You can't do that. So you have to live with some sampling risk here. But if you want to go ahead and get that risk smaller, test more items. If you can accept a larger risk, then you can test less items, inverse relationship, okay? Okay, let's look at tolerable deviation rate. Tolerable deviation rate is the maximum rate of deviation from the prescribed control the auditor is willing to accept without determining that the control does not have operating effectiveness, okay? Now, when you look at that, that's a little bit different, a little bit more difficult to see. I think risk of assessing control is too low is pretty intuitive here. So let's just do an example of a tolerable deviation rate, okay? So, and guys, this is not something that you'll see in your test or anything. This is not according to standard, but I've seen some literature that describes how the auditor would look at tolerable deviation rate and its effect on sample size, okay? So what happens? Let's say we have our risk assessment. Okay, good. My eraser is working now. So we have our risk assessment. Okay. We have our tolerable deviation rate. And then we have our sample size for our control testing, of course. Okay, and so we come over, and when we look at the risk assessment, say we've assessed the risk at low. Okay, remember we have to assess the risk of material misstatement. So our control risk, our CR up here, control risk assessment. Okay, our control risk assessment is low. What literature will tell you, if that's the case, you're probably in a tolerable deviation rate of 0 to 3%. Okay, so what happens? An auditor will, before they test one item, the auditor will sit there and say, okay, I am going to look at 100 time cards, and I am willing to accept up to 3 times that the supervisor didn't sign it before I'll say, you know what, this control does not have operating effectiveness. You say 3 out of 100? That's pretty conservative here. That's right. It is conservative because I have assessed my control risk at low. If I assess my control risk at low, I'm saying what? Good design to this control. I saw that it was implemented. I like the design. I'm really going to rely on this control. I'm going to assess my risk assessment at low. So if that's the case, we said what? My sample size is going to be fairly large. Inverse relationship between tolerable deviation rate and sample size, and that's a pretty low tolerable deviation rate that I'm dealing with here. I'm only willing to accept 3 out of 100 time cards that were not signed before I'm going to believe that this control that I have has supported the low assessed level of control risk. Now, let's say that I set my assessment at moderate. Okay, and now I'm going to turn around and I'm going to say, okay, since it's moderate, I'll take 4 to 7% tolerable deviation rate. Okay, that's 4 to 7%. I should have just left it as it was. It was clear that we're talking percent here, right? Okay, so it's 4 to 7%, okay, is my tolerable deviation rate. So now what happens? Now I'm saying, okay, you know, this is a pretty good control. It's not the greatest in the world. The design is okay. I'm going to rely somewhat on it, but I'm not going to stake my whole, you know, auditing, my whole license and my CPA on, you know, this test working out or not. So I'll probably have some other things that I'm going to be looking at, and I'll probably be doing more, obviously be doing more substantive testing. My control risk is a little higher now. And so what happens when I do my sample size for my control testing? I could probably put control testing sample size up here. Okay, so this sample size that we're talking about, of course, guys, remember, is for my control testing, is what we're focusing on. So my control testing sample size here now will be smaller. Okay, it's going to be smaller relative to what we had up here. Here it was larger, right? So we go from larger to smaller sample size because I'm not relying as much on that control, so I don't need to look at as many items to make sure for sure that that particular control has operating effectiveness, right? Now let's think about this. If, and the literature tells us that you're sitting there and you're at a high control risk, you set your control risk at the maximum. Okay, high / max. There's no requirement that we use a certain adjective to describe our assessment of our control risk. They're telling you if that's the case, you know, you're probably dealing with tolerable deviation rates of 8% or more. Okay, and so what happens here? What's my sample size now? My sample size is 0 now. My sample size is 0. I don't do my control testing. I bypass my testing of operating effectiveness and go straight to my substantive testing. Okay, so that little, you know, and I've seen things that will describe this sort of stuff, is why we say that there is what? Inverse relationship, right? Inverse relationship, just like there was here to sample size. If I'm willing to tolerate more misstatement, I shouldn't say misstatement. If I'm willing to tolerate more deviation in the control, then what? Then I would go ahead and assess my tolerable deviation rate. I would assess if I'm willing to tolerate more, my tolerable deviation will go up, sample size will come down. If I'm saying, no, this is an important control, I'm going to only tolerate a few deviations from this control, then I'd have to have larger sample sizes. Now, we have the tolerable deviation rate, okay? We were saying, for example, say 3 over 100, that's 3%. I think you know that. 3%, okay? And we're sitting there. At this point, we haven't looked at one transaction yet. We haven't looked at a single time card. At this point, okay? At this point, we are just saying this is what we'll tolerate. Now, we'll actually pull the time cards, look at them, and we'll see what the number is that didn't meet our requirements. And let's say we pull 4 out of 100. Okay, well, now we're clearly what? We are clearly in excess of our tolerable deviation rate. will determine, hey, this sample does not have operating effectiveness, and at that point we're going to go ahead and turn to some other control that will hopefully compensate for the control that just failed this test. Okay, so that's how that works. And maybe there's another control around the existence assertion that'll help prevent or detect a misstatement. Okay, so that's how tolerable deviation rate works. Expected deviation rate, there is a direct relationship. Expected deviation rate is what I think the deviation from the control will be. Okay, now how do I know what to expect? Well, typically, if you've had a client in previous years that has that you have experience with, that they don't apply the control correctly, whatever, then you're going to have a larger sample size. Even if the day you walk in, the client says, hey, we fixed the problem, right? We're still going to pull a large sample size to see if it's true, if they fixed it. In fact, we might go a couple more years, the first year that they tell us they fixed it, hey, pretty good. Second year, we still might keep that sample size a little bigger just to make sure now that it's in their DNA and they know how to apply that control. Maybe on that third year, we can pull a smaller size of our sample because our expected deviation rate is coming down. So direct relationship. Population size typically does not affect the sample size, okay, for larger populations. For smaller populations, it could have more of an effect on sample size. Most of the tables that we're about to look at in the next couple slides assume a large sample. We're not going to be using the tables. There's a different set of tables that the AICPA uses for sample sizes. American Institute of Certified Public Accountants, in their sampling guide from SAS 39, their sampling guide will have some tables that you should use for smaller populations, but the logic works the same. So we're not going to worry about smaller sample sizes. We're just going to assume larger sample sizes, and it has really no effect on our, not sample size, but larger populations, and that it really has no effect on our sample size. So we're assuming larger populations. Okay, good. And there's our little illustration of tolerable deviation rate. Okay, so let's just go ahead then and let's take a look at this example. And this is a pretty nice little example in which they give us what? They give us the desired confidence level, which is the risk of assessing control risk, what? Too low. Okay, so they're translating that now into confidence level, which is related, or another way of saying our risk of assessing control risk too low. So we want 95% confidence. That means we're only willing to accept a 5% risk that will assess as control risk too low. If we wanted only a 1% risk of assessing control risk too low, then we would be looking at the 99% confidence. Okay, so 1 minus 5% risk of assessing control risk too low is where we're getting this 95%. Okay, then what? Tolerable deviation rate, they're telling us is 6%, and we have an expected deviation rate of 1%. Okay, and in this example, we're pretending here that we're looking for a sales order that is missing credit approval, whatever. Okay, so we have these numbers, and we go ahead and we take a look at the, and again, remember guys, we're doing this for what? The valuation assertion. So we always look at controls around the valuation assertion. So we come in and we take a look at the next page here, and we have the table, and we're on the 95%. Okay, it could be, they could call the table 5% risk of assessing control risk too low. Okay, so we're the 5% risk of assessing control risk too low. So we know that that's corollary to the 95% confidence level. Then we come down and we had an expected, now I got to go back. What was expected? The expected was 1%, and our tolerable deviation rate is 6%. So we have a 1% expected deviation rate, and our tolerable deviation rate is 6%. So you come over to 6%, and we have a sample size of what? 78. Okay, again, you say, well, what about population size? we would go to a completely different table. Okay, this is assuming a larger population. Okay, so they tell us there's a bunch of items in the population. Okay, all right, so that's 78. Now you take a look. Okay, they put the arrows in for us, but you take a look here, and what would the sample size increase or decrease if the expected deviation rate decreased to 0? Okay, think about it. Sample size is going to do what? Sample size is going to decrease because there's what? There is a direct relationship. So if expected deviation rate goes down, then my sample size goes down. And you come over and you take a look, and sure enough, if I decrease the expected deviation rate here, you come over and let's just take a quick look at that. Use a different color for 0. Now we're at what? Now we're at 49. So the sample size decreased. We were right. Not only could we say that it decreased, we can say that it decreased to 49. You can actually put a number in there. Okay. Would sample size increase or decrease if the tolerable deviation rate increased? Tolerable deviation rate, willing to accept more deviation from the control. So what's going to happen? My sample size is going to my sample size is going to decrease because I'm willing to accept more deviation from that control. I must be telling you, hey, this control, I'm not going to rely on it as much. I've assessed my control risk at, say, moderate. But let's just confirm with the table. You come over and, oops, not that way, this way, back to the previous table. And you take a look, and they told us the tolerable deviation rate, what? Increased in that example, and it would increase from what? Say, well, we better go to 7% because we're running out of room on this table. It would increase tolerable deviation rate to 7%. Sure enough, sample size will decrease. It will decrease to 66. Okay, so you come back over, and we can go ahead and answer that question there. Put it at what? Decrease to 66, right? Okay, good. And then would the sample size increase or decrease if the risk of assessing control risk too low increased to 10%? Now, hang on, be careful. I can't rush over to the table to answer that because what? That's a completely different table. We're over here at the 5% table, the 95% confidence level, 5% risk of assessing control risk too low. We can't use this table. But think about it. I'm willing to accept what? More risk. I'm now at 10% risk that I'll make the wrong decision, assess control risk too low. And we said what? There's a inverse relationship to the risk of assessing control risk too low, the confidence level, and the sample size. So I can tell you that all the numbers on the 90% table are smaller than the numbers on this one, right? And so my sample size is going to decrease. Okay, good. So we determine our sample size here, whatever it would have been, 78, whatever. And once we determine the sample size, then we have to evaluate the sample. Okay, so our sample size was 78. We look through the time cards or the credit reports, whatever it is we're looking at here, the credit approval on the sales orders, whatever it is. And we looked through the 78 and we found 2 where there wasn't the appropriate credit approval. Okay, so what happens? We take that 2 and we divide it by 78, okay? And when you do, you get something like around 2.67 or something like that. They've only rounded it to 2.6, but anyway, you get this 2.6. I'm not sure why they would put 2.7, but that's fine. So it's 2.6, 2.67, whatever, okay? Now, the upper deviation rate, they say computed, we would have gotten the upper deviation rate from the table that we're going to look at on the next page, and we have a tolerable deviation rate of 6%, okay? So let's just look at this table. There it is, 2 divided by, oh, I see. It was 2 divided by 78 is where they came out with 2.6. Sorry, guys, I had divided 2 by 75 because I forgot the sample size. And now it doesn't want to let me erase that. Okay, nothing worse than making a mistake and not being able to erase it. So it's 2 divided by 78 is the sample size. So that's going to give me where they got this 2.6. Okay, and we'll just go with their math on that. So you take a look, and that's the 2.6. That's the deviation rate. 2 out of 78 is my 2.6, right? Okay, 2 out of 78. And then I come over and I come to my sample size, which is 78. Okay. Well, that's very nice of them to give me a sample size that's different than the number on this table. So I'm going to come over here to the closest number I've got, which is 75. Oh, no, this example is a little bit to be desired here. Okay, and they tell me that that's 8.2. And I don't know what the heck the developer of the textbook is doing here, why they're giving me a different sample size. You know, I could use a software to get me the exact upper deviation rate based on the exact sample size. So they should have forced this example so that the sample size matched the table. But 8.2, okay, is, I guess, the most conservative number that we could use here for a sample of 78. So I guess they're saying, look, go with the higher number, okay? And so what happens? We have this 8.2, okay? And when we have this 8.2%, okay, that's what we're saying the highest that particular deviation could go for this sample. Again, we're not exact because we're still saying there's a 5% chance that this is some weird sample and we'll just end up being flat wrong. But we're 95% certain that the deviation rate in this sample, the upper end, will not exceed 8.2%, okay? And they look at you and they say, auditor, can you live with that? Well, if my tolerable deviation rate was 6, the auditor is going to look at that and say what? Say no. I cannot rely on this control because what? I was really only willing to accept 6%, and this table, no percent, yeah. No, okay, I'm not going to rely on it. Now, no percent am I going to rely on this. My answer is sitting here at no. I would not rely on this control because I was willing to accept only 6%, and this table is telling me it could be as high as 8.2%, okay? Now, they call this precision, okay? And when the elections and stuff are going on, they'll say, hey, you know, Obama was ahead, Hillary was ahead, whatever, Trump was ahead, whatever election you want to look at. And when they look at that, they always give you that little plus or minus 3%, whatever it is down there. That's telling you that what, on either end, we could have some wiggle room around what we're telling you the results of this sample is. Well, in election, it matters on one side or the other. Here, since we just want to see if we have exceeded our tolerable deviation rate, they just give us the upper end here. And we look at this, so we're looking at the most conservative worst case scenario here, and they're telling us, hey, you know, at the upper end, worst case scenario, it's 8.2%. How does that compare to your tolerable deviation rate? And you look, it's exceeded it. Now, we're doing this precision analysis here with this thing because, look, our analysis, when we look for the two errors, told us that we were at 2.6%. Well, what's going on? There's a cushion in there, a pretty big cushion. If you look at the what? You look at the 8.2 minus the 2.6. What have we given ourselves here? A pretty good little chunk of what may be 5.6. And that 5.6 is the allowance for sampling risk. Remember, we're saying there's always a chance that this is a weird population, that the sample is going to lead me astray, that there's going to be something different in there than the actual result. And so this allowance for sampling risk of 5.6, this table is building in a cushion that says to me, you know, you could be this far away from what your estimate is, and so we're going to put a little cushion in there to protect you. Okay, and so we say, okay, upper end, it could be as high, we're 95% certain, could be as high as 8.2. My tolerable was 6, so I'm not going to rely on this control. Now, it is possible that we could have had a tolerable deviation rate of, say, I don't know, we'll put it up around 9%, let's say, okay, just for kicks, although I don't think we had tolerable deviation rate at 9%. I doubt we'd even be doing this test on this, but just to keep this example alive here, let's say that we put it and we said, okay, we're willing to accept a 9%. So now let's say instead of our tolerable deviation rate being 6, let's say it was 9%. Well, if our tolerable deviation rate was 9%, which if it was that high, I doubt we'd even do the test. But if it was at 9%, then would we rely on the control? Answer, yes, because this table is telling us, hey, out at the outer ends of what could be going on here, you would be as high as 8.2, and you're at you're willing to accept 9%. So now the auditor would rely on that control. Okay, but here in this example, since they were saying it was 6, the conclusion would be no, we are not going to rely on that control. Okay, so because the tolerable deviation rate is less than the upper deviation rate, the auditor is not going to rely on that control. Again, if it was up and that it came out 8.2, kind of makes it not very realistic that we would go as high as 9 and still expect to get any kind of help from this internal control. But if it was, then we could go ahead and rely on the control. Okay, good. Now you come over and they remind us that we could use non-statistical sampling. Okay, and you can see that they give us some sample sizes. Again, control reliance is desired level control reliance, and they're saying is low. And they show, yes, smaller sample sizes. If we're going to rely on the control more, larger sample sizes. I don't like that they use low, moderate, high, because that sounds like the assessment, and it's the amount of reliance. So this would be inverse to the control risk assessment. Okay, this is going to be inverse to that, just to make sure we're not talking about control risk assessment here, guys. We're talking about what? Desired level control, which means reliance, which means we would have what? We would have a high control risk assessment if we're not relying on it more. Moderate, if we're going to control risk assessment, we're going to rely on a moderate. And if we had a low control risk assessment, then we could have a high reliance. So that's sort of different way of looking at it, I guess. Indeterminate sample size, and notice we're talking about non-statistical sampling now, so it just gives an idea of a firm policy as to what your sample size would be. Remember, we said it's okay to use non-statistical sampling. We're just not going to be able to talk about 95% confidence level, upper deviation rate, okay, can we rely on the control? Okay, we're 95% certain that this control has the level of operating effectiveness that we're looking for. We can't quantify any of that if we don't use statistical. We're talking about non-statistical sampling, okay? Okay, good. We can also use something called haphazard sampling, which we could sit there and say, well, we're going to go ahead and select every fifth item or something like that. That's haphazard, and again, that is not going to be allows the use of random or systematic selection, but also permits haphazard, saying that we're just going to look at every fifth item, or we're just going to throw the cards in the air and pick the ones that come down. Could be considered haphazard. Okay, not the best method. We're really looking for random when we do these things. Okay, good. Let's take a look at a couple questions then. In addition to evaluating the frequency of deviations in tested controls, the auditor would also consider certain qualitative aspects. Yes, we didn't talk about that. as much, but we look at the qualitative aspects as well as just the way the sample turns out. So if we're looking and we're seeing that there was a forged document involved, well, that's going to have larger implications in the audit than just the pure, well, they didn't sign off on a sales order. We found that they gave us one in which the signature was forged or was put in there after the fact or something. That's going to have larger implications on the audit than just the pure results of the test. Okay. Audit plans to examine a sample of 20 checks for co-signatures as prescribed by the entity's internal control procedure. One of the checks in the chosen sample of 20 cannot be found. Well, how do we treat an item that's missing? If an item is missing, we treat it as a deviation from the control procedure because we can't see it. It can't be, hey, Joe, did that one that's missing have the signature, right? Oh, yeah, that's right. No, we have to see it to believe it, right? And so if it's missing, we will treat it as a deviation for our sampling purposes. Okay, let's take a look at this one. Which of the following statements is correct concerning statistical sampling in our compliance testing? We're talking about compliance testing, complying with the prescribed controls. So for our control testing, and we've seen that the population size has little or no effect except for very small populations. And when they say very small, I think it's like populations of 25 or something like that, or not populations of 25, populations of around 100 or something. I think they can use smaller sample sizes on some of those tables, different tables. Our tables, we're assuming very large populations, the ones that we use, and that's all we need to concern ourselves with for our purposes here. If you have a smaller sample size, you go to a different table. Okay, good. In determining the sample size for a test of controls, an auditor should consider the expected deviation rate, desired confidence level, and tolerable deviation rate was the other one that affected our sample size. And notice we didn't bring in the population size in that consideration, and we were assuming larger samples. Okay, a control is deemed to be more important than thought at the time that the attribute sampling parameters were set. The auditor is most likely to respond by decreasing the tolerable deviation rate, right? If we think a control is very important here, then we'll decrease that tolerable deviation rate. We'll have a larger sample size for our control testing because we're saying, hey, this is a pretty important control that we're looking at. Okay, good. That takes us through Chapter 8, okay, and you'll see some of the homework questions similar to the ones we went through here in this chapter, and of course those will translate into your quiz and then ultimately to your midterm questions. Okay, guys? All right, we'll see you in Chapter 9.